All right, let's dive straight in. We're looking at Las Vegas Sands, Q3 2025 earnings, the mission, cut through the numbers, figure out what management's really saying about Macau and Singapore and where all that cash is going.
And you really had to pay attention here. This wasn't just a small beat. LVS made a pretty major statement. The stock reaction tells you a lot.
Okay, let's hit those headline numbers first, because they really blew expectations out of the water. Earnings per share, 0.78 cents. A forecast was what, number 61 cents?
Yeah, 61 cents. So that's a 27.87% surprise. Pretty significant.
Huge surprise. And that wasn't the only thing, right? Revenue also beat.
Absolutely. Revenue came in strong at $3.33 billion. They were expecting more like $3.06 billion, so an almost 9% beat there.
Wow.
And that flows right down. Net income attributable to LVS, $419 million. And the big one, consolidated adjusted property EBITDA, hit $1.34 billion.
$1.34 billion EBITDA. That's up 35.6% from last year. That's massive growth.
It really is. Shows they're riding that recovery wave in Asia incredibly well. And the market noticed.
Yeah, talk about the stock reaction. It wasn't immediate, was it?
No, that's the interesting part. Right after the announcement, after hours, pretty muted. Up just 0.16%. Barely a blip.
Huh.
But then, give it a day. People digest the call, the guidance, and the stock closes up nearly 13%.
So it took a beat for the big money to realize, okay, this isn't just noise, this is real.
Exactly. It was a validation, and you saw that reflected in the analyst community immediately.
Oh, yeah. What did they do?
Just a flood of confidence. We saw, I think, 11 price target raises almost right away. JP Morgan, for instance, bumped their target way up from $60 to $70.
$70.
Yeah. And Investing Pro data, it shows some targets heading up towards $73.50. So the feeling is, even after that big jump, there's still value there. Undervalued given the cash flow.
Right, which brings us neatly to that whole capital allocation thing.
Yeah.
Management really hammered this point home. The president, Patrick Dumont, basically said LVS is a capital allocation story and a return to capital story.
That was the mantra. And they backed it up with actions, not just words. Very aggressive actions.
Okay, like what specifically? Dividend first.
Dividend first. The board signed off on a 20% increase for the quarterly dividend. That's for the 2026 calendar year. Pushes the annual payout to $1.20 per share.
Under 20-cent annual. That's 0.30 cents a quarter. That sends a strong signal about stability, right?
Definitely. Signals that they see this strong performance continuing. But the real eye-opener was the share repurchase program.
Yeah, they seem to be throwing serious money at buybacks.
Serious is an understatement. Just in Q3, they bought back $500 million of their own stock, average price around $54.39.
Okay.
But the forward look, they authorized adding another $2.0 billion to the remaining repurchase amount. $2 billion. And extended the program out to late 2027.
Wow. So how much have they bought back total since they restarted this thing?
Since they brought it back in late 2023, $4.0 billion. They've taken out 11.5% of their outstanding shares in just the last 8 quarters.
So management is clearly betting on themselves. Big time. They think their own stock is the best place for that capital.
It's the clearest signal possible, right? It says, we think our shares are cheap, and this is the best return for shareholders right now.
Which, makes you wonder, if they're authorizing another $2 billion in buybacks, does that mean they don't see any big splashy acquisitions or like major new growth projects on the immediate horizon? They did shut down that digital gaming thing.
Right, and they explicitly said they're not looking at the UAE right now.
Okay.
So yeah, I think it absolutely points to that. It suggests finding high return M&A is tough. Calling digital not a good use of shareholder capital and avoiding the UAE bidding war, that signals real financial discipline.
So focus on the core, Macau and Singapore, maximize those, and return the rest.
Precisely. Until, maybe some truly massive opportunity comes along. Right now, they're investing in LVS itself.
Okay, let's talk about those core assets then, because it's really a tale of two cities, isn't it? Singapore versus Macau.
Completely different stories right now. Singapore, Marina Bay Sands is just... it's on another planet.
What are the numbers there?
$743 million in adjusted property EBITDA. That's up 83% year over year. 83%.
Good grief. And the margin.
Get this, 51.7% margin. You just don't see margins like that very often.
Incredible. And what's driving that? Is it VIP?
Nope, that's the key. It's the mass market. They hit an all-time record for property mass win, $905 million. And remember, that's your everyday players, your premium mass, not the volatile, high-roller junket stuff.
Right, so stable, broad-based demand.
Exactly. Mass win grew 35% compared to Q3 last year. It's so strong. The CEO, Rob Goldstein, basically admitted their old $2.5 billion annual EBITDA forecast for Singapore was way too low.
He actually said that.
Yeah, he said something like, Singapore's taken a whole new, we can't figure out just how high is up. They're going to blow past that $2.5 billion for 2025 easily.
Can't figure out how high is up. That's quite a statement. Okay, so Singapore's flying. What about Macau, the historical heartland?
Macau is more of a grind right now. Still profitable, but the growth isn't explosive like Singapore. Adjusted property EBITDA was $601 million.
Only up slightly year over year.
Yeah, just 2.7% growth year over year. And the margin's lower too, 31.5%. Plus, they got dinged by about $20 million EBITDA from that typhoon during the quarter.
Okay, but I did see one encouraging sign there. Mass market revenue jumped quite a bit compared to the start of 2025, right? Like 25% up from Q1.
That's right. And that's the key point management wanted to make. They admitted they'd been underperforming in Macau, maybe relying too much on just having nice buildings.
Like the Londoner, the Venetian.
Exactly. But since Q2, they've really changed their marketing, focusing hard on that premium mass segment, trying to get them back and keep them.
So it seems like that strategy is maybe starting to work, even as the year-over-year numbers aren't spectacular yet.
That's the hope. They feel they're maybe halfway there in terms of getting the Macau strategy right.
Okay, so what's the target? Where do they need Macau EBITDA to get to?
The goal is ambitious. They're shooting for $2.7 billion to $2.8 billion annually in Macau.
Right. And how do they get there? Is it just fixing their own operations, or do you need the whole market to lift?
It's got to be both. They need the overall Macau market GGR gross gaming revenue to keep growing. They're thinking maybe it needs to hit $33 to $34 billion next year.
Okay, market growth helps.
And then they need their internal fixes to keep working. They talked about really leveraging the big properties, but also fixing, quote, weaker links like the Parisian and Sands Macao, tailoring the marketing for each place.
Sounds complex. Okay, so Macau is a work in progress. Singapore's booming. Let's talk about their edge. What keeps them ahead? Seems like tech and big investments.
That's exactly it. And one of the most interesting bits from the call was about this smart table technology they're using in Singapore.
Smart tables. What's that about? How did it make such a difference?
Well, this tech lets them measure the theoretical hold rate really accurately, especially for baccarat. You know, theoretical hold is the house edge the casino should statistically win over time, based on the game's math.
Right, the built-in advantage before let comes in. So what did the tech reveal?
It revealed a theoretical hold at MBS of 4.2% in Q3.
4.2%. But isn't baccarat famous for having a really low house edge, like under 3%?
Historically, yeah. People called it a boring 2.85% game. So jumping from, say, 3.5% last year, or that historical 2.85%, all the way up to 4.2%. That's a massive swing in profitability. We're talking huge money.
How is that even possible? What changed in baccarat?
The players changed. Or rather, their preferences did. Management said it's simply mathematics. Players are choosing side bets more often, things like commission-free baccarat, dragon bonus, pair bets.
The bets with higher volatility and higher house edges.
Exactly. Some of those side bets have house advantages way up near 10% or more. So players are opting for more action, taking on more risk for potentially bigger payouts, and that drives up the overall theoretical win for the house. The smart tables just accurately record what's happening.
So the tech isn't magic. It just proves that player behavior is shifting towards higher margin bets for the casino.
Precisely. It gives LVS the data to see what works and lean into it. And here's the strategic kicker. They plan to roll out this tech and these specific side bet strategies across Macau.
So exporting the Singapore success formula, that's their competitive advantage. Understanding and capitalizing on these player preferences.
That seems to be a big part of it. It's a way to boost profitability, even if the overall market isn't exploding. It's structural.
Okay, shifting from tech inside the casino to the massive construction outside, that IR2 expansion in Singapore, $8 billion investment, a serious commitment.
It's a monster project. The Marina Bay Sands expansion, IR2, it's all about keeping MBS at the absolute peak. We're talking a new all-suite hotel tower, 570 ultra-luxury suites, a huge 15,000-seat arena for entertainment, more MCE space, meetings and conventions.
Why spend that much? Is it just belief in Singapore's future?
Well, yes, but it's also kind of required. Remember, Singapore is a duopoly. just LVS and Resorts World Sentosa. Part of their deal with the government involves these massive reinvestments to keep their exclusive licenses.
Ah, so it's a cost of maintaining that incredibly profitable position. Keeps competitors out.
Essentially, yeah, ensures their long-term position in one of the world's best gaming markets.
Did you hear the timeline slipped a bit, though?
It did. They're now targeting completion around June 2030, opening maybe January 2031. They'll likely need an extension from the government beyond the original July 2029 deadline, but that's pretty normal for these huge projects. Shows they're prioritizing getting it right over rushing.
Okay, so wrapping this up, two big takeaways seem clear. First, Singapore is just this incredible runaway success story driven by mass market and smart tech.
Unprecedented success, really.
And second, LVS is being incredibly aggressive about returning cash to shareholders via dividends, and especially those huge buybacks, while they work on the Macau turnaround.
Yeah, Singapore's strength funds everything else. It gives them the firepower for the Macau fix and the shareholder returns.
So here's something to chew on as we finish. You mentioned those Singapore hotel rooms. The average daily rate, the ADR, was $982 this quarter, almost $1,000 a night.
Insane number.
Right. But management kept saying LVS is not in the rooms business, that the rooms are basically just comps, tools to get high-value gamblers in the door to play.
Yeah, that's their philosophy. The casino drives the profit, the rooms support the casino.
Okay, but think about this. Singapore tourism is booming, demand for luxury is sky high. What happens if the sheer success of the market starts pushing that ADR consistently over $1,000, maybe $1,200 a night? Does LVS reach a point where the pressure to just sell those incredibly valuable rooms for cash contradicts their core belief that the rooms should primarily be freebies for gamblers? Can the hotel become too successful for its own good, according to their strategy?